Last week, Amazon announced they will spend between $100 and $120 billion on AI infrastructure in 2025. Wall Street applauded. Analysts raised their price target. But while everyone was celebrating this technological ambition, I was looking at something completely different. I was looking at Amazon's operating margins falling from 5.9% to 4.8% in the last quarter. I was seeing fulfillment costs rising faster than revenue. And I was calculating how long a company can burn money on expensive bets before the mathematics stops working. Let me be direct about what's happening here. Amazon has built one of the most impressive businesses I've ever seen. Their e-commerce completely changed retail. AWS revolutionized cloud computing and generates enormous profit. But here's the problem nobody wants to discuss. Every great company eventually reaches a point where growth becomes harder, margins start compressing, and massive investments stop generating the returns they used to generate. My analysis of the numbers tells me Amazon may be exactly at that point now. Over the last 12 months, Amazon generated approximately $620 billion in revenue. Impressive. But when you look beyond the top line and examine actual profitability, you see something worrying. Operating profit was just $53 billion. That's an 8.5% operating margin. For a company this size, spending over $100 billion a year on CapEx, that margin simply isn't enough. And it's getting worse, not better, as they continue pouring money into AI, new distribution centers, and increasingly desperate attempts to defend their market position. Here's what really concerns me. Amazon is trapped in a classic growth trap. They need to keep spending enormous amounts just to maintain their competitive position. If they stop investing heavily, companies like Shopify, Walmart, and even China's Temu will eat their market share. But if they keep spending at these levels, they'll never generate the kinds of returns on capital that a mature company should produce. It's a no-win situation that I've seen destroy shareholder value repeatedly over the decades. Charlie Munger taught me that the best business isn't the one that grows fast. It's the one that can grow while improving margins and generating growing free cash. Amazon is doing the opposite. They're growing while compressing margins and burning cash on increasingly expensive investments with increasingly uncertain returns. This isn't a business at its peak. This is a business that's already past its peak and desperately trying to hide that fact behind revenue growth numbers that mask the deterioration of fundamental economics. Now, let me explain exactly why Amazon's situation is more dangerous than it appears on the surface. When Jeff Bezos built the company, he had a simple mantra: sacrifice short-term profits for long-term growth. And for many years, that strategy worked brilliantly. Amazon reinvested every dollar back into the business, expanding product categories, building AWS, creating investors accepted low margins because they could see where it was going. But now, something fundamental has changed. Amazon is no longer sacrificing profits to build sustainable, competitive advantage. They're sacrificing profits just to maintain their current position against a rising tide of competitors. Think about this for a moment. When Amazon built AWS, they were creating a completely new business that became incredibly profitable. When they built Prime, they were creating customer loyalty that generated lasting value. But when they spend $120 billion on AI now, what exactly are they building that competitors can't replicate? Here's the brutal mathematics that Wall Street doesn't want to face. Amazon is spending over $100 billion a year on capital expenditures. For a company this size to generate adequate returns on that capital, they'd need something like $15 billion in incremental annual profit just to justify the spending. But what are we seeing? Margins compressing, not expanding. Operating costs growing faster than revenue, and competition intensifying in every segment of their business. Let me give you concrete numbers from the last quarter that should frighten any rational investor. Amazon's e-commerce business generated $270 billion in revenue over the last 12 months, but the segment's operating margin was just 4.2%. Compare that to Walmart, which is doing 25% operating margin in their retail business. AWS, which used to be the crown jewel with 30% margins, is now seeing those margins fall as Microsoft and Google compete aggressively on price. The advertising segment is growing but faces fierce competition from Google, Meta, and even TikTok. What deeply concerns me is that Amazon is stuck in a situation where they have to run faster and faster just to stay in the same place. They need to spend billions on faster deliveries because consumers now expect same-day delivery. They need to spend billions on AI because their competitors are doing it. They need to keep expanding distribution centers because volume keeps growing. But each of these investments generates smaller returns than previous investments. It's the law of diminishing returns in action, and it's happening in real time in Amazon's financial reports. For years, Amazon investors had a simple answer to any concerns about profitability: AWS. The cloud computing business was so profitable, growing so fast, and had such high margins that it completely offset the low margins of e-commerce. But let me tell you what's happening with AWS now, because it's a story that should fundamentally change how you think about Amazon as an investment. AWS can no longer carry the rest of the company on its back. Last quarter, AWS generated approximately $105 billion in annual revenue, with operating margin falling to about 26%. That's still good compared to e-commerce, but it's consistently dropping. 3 years ago, those margins were near 30%. The compression is happening because Microsoft Azure and Google Cloud are fiercely competing for market share, and when you have three tech giants fighting for the same enterprise customer, what always happens? Price war. And in a price war, margins are the first casualties. Here's the mathematics that keeps me up thinking about Amazon. AWS generates about $27 billion in annual operating profit. The e-commerce business generates maybe $11 billion. The advertising segment adds a few more billion. That gives you about $45 to $50 billion in total operating profit. But Amazon is spending over $100 billion a year on CapEx. Even after accounting for depreciation and other accounting adjustments, they're essentially spending every dollar of operating profit, and then some on investments that generate increasingly smaller returns. Now think about what this means when AWS can no longer grow its margin. The company's profit engine has reached its peak. It can't offset the deteriorating e-commerce margin. It can't indefinitely finance the $120 billion in AI spending. And it can't protect Amazon from the reality that they've built an empire that requires massive ongoing investment just to avoid losing market share. This isn't the description of a great company at its peak. This is the description of a company trapped in a capital-intensive trap. Compare Amazon's situation to what I see in truly excellent businesses. When I own a stake in a company like Apple, I know they can generate gross margins of 40% or more on their products. When I look at Coca-Cola, I see a company that can raise prices with inflation and maintain margins because it has real pricing power. Amazon has none of these luxuries. They operate in brutally competitive markets where any attempt to raise prices or cut investments immediately results in losing customers to competitors desperate to take market share. Let me tell you about something that should terrify any Amazon investor. The company is facing serious competition in literally every segment of their business. And unlike the early days when they could simply outspend competitors, now they're fighting companies with equally deep pockets and, in some cases, better structural advantages. In e-commerce, Walmart has invested heavily in its online platform and is using its thousands of physical stores as distribution centers. This gives them a cost advantage that Amazon can't easily replicate. Then there's Shopify, which is enabling millions of small merchants to sell directly to consumers without needing to go through Amazon. And here's the fundamental problem. When you sell on Amazon, they take 15% to 45% of the sale in fees. When you sell through Shopify, you keep much more of the profit. As more merchants realize this, they're building their own direct to consumer brands and using Amazon only as an additional distribution channel, not as their primary platform. This completely undermines Amazon's pricing power. In China, Temu is selling products directly to American consumers at prices Amazon simply can't match. They're completely bypassing Amazon's expensive infrastructure and delivering products from China directly to American consumers. Yes, it takes longer, but when you can buy something for $5 on Temu, that costs $25 on Amazon, many consumers are willing to wait. And this dynamic is only beginning. As Chinese manufacturers become more sophisticated at reaching Western consumers directly, Amazon's entire middleman model becomes threatened. On the cloud computing side, Microsoft has an enormous structural advantage through Office 365 and Windows enterprise relationships. When they sell Azure to a company already using Microsoft products, the integration is seamless. Google is leveraging its AI capabilities to win customers from AWS. And here's what really matters. These aren't small competitors Amazon can simply outspend. They're trillion-dollar companies that can match every Amazon investment and have specific advantages in their markets. Even the advertising business, which everyone points to as a bright growth story, faces serious headwinds. TikTok is stealing attention from young consumers. Google continues dominating search. Meta has Facebook and Instagram, where people actually want to spend time. Amazon advertising works because people are already there to buy something, but if traffic starts migrating to other platforms, the value of those ads drops quickly. And with all the fees Amazon charges sellers, many are starting to question whether it's worth paying for visibility on a platform that's getting increasingly expensive and increasingly less dominant. Throughout my career, I've learned to recognize certain patterns that appear repeatedly when great companies reach their peak. And when I look at Amazon today, I see practically all of those warning signs flashing in bright red. The first sign is when a company starts dramatically increasing spending while margins compress. Amazon is doing exactly that. They're spending more than ever, but generating less profit per dollar of revenue than they generated 3 years ago. That's not healthy growth. That's a company desperately trying to maintain its position. Let me tell you about General Electric because there are disturbing parallels. At the turn of the millennium, GE was considered America's best managed company. Jack Welch was worshipped as the greatest living CEO. The company was everywhere, doing everything from aircraft engines to financial services. And then, slowly, people started realizing that all that growth was hiding fundamental problems. Margins were falling. The conglomerate was too complex to manage efficiently. And when the 2008 financial crisis hit, the truth became naked. GE was fragile, over-leveraged, and built on weaker foundations than everyone thought. Amazon isn't exactly GE, but the pattern is similar. They've built an empire so large and complex that it requires massive ongoing investment just to function. E-commerce needs billions in new warehouses. AWS needs billions in new data centers. The advertising business needs constant technology to compete with Google and Meta. Amazon devices need subsidies because nobody would buy them at full price. And now, on top of all this, they're adding $120 billion in AI spending because they can't afford to fall behind. Here's another historical warning sign. When the visionary founder leaves, Jeff Bezos stepped down as CEO in 2021. Yes, he's still involved, but he's not in daily operational command. And what's happened since then? Financial discipline has loosened even more. Spending has accelerated. Bets have gotten bigger and riskier. Andy Jassy, the new CEO, came from AWS and seems to be running the company as if he were still running just one highly profitable segment, without fully understanding that the total conglomerate has very different economic dynamics. Think also about companies like Sears, which once dominated American retail as completely as Amazon dominates e-commerce today. Sears had the catalog. They had stores everywhere. They seemed invincible. And then came Walmart, then Target, then specialized retailers, and eventually Amazon itself. Sears kept investing heavily, building new stores, modernizing their infrastructure. But none of it mattered because the fundamental business model was being eroded by competitors with better structural advantages. I'm not saying Amazon will go bankrupt like Sears, but I am saying that market dominance isn't permanent. And when you see margins compressing while investment accelerates, it usually means the best part of the growth story has already passed. So here we are. Amazon is spending $120 billion a year on an AI arms race with no clear finish line. Operating margins are compressing from 5.9% to 4.8%. AWS, which used to be the profitability savior, can no longer offset the deteriorating e-commerce, and the company faces fierce competition from all sides, from rivals with equally deep pockets and specific structural advantages. To me, these aren't signs of a company at its peak. They're signs of a company that's already past its peak and running faster and faster just to avoid falling. Let me be absolutely clear about what I would do if I owned Amazon stock today. I would sell. Not because Amazon is going bankrupt, not because they don't have a real business, but because the risk-reward relationship has fundamentally changed. When a company is spending every dollar of operating profit and then some on investments with diminishing return, while facing growing competition and margin compression, the odds simply don't favor the investor. You're holding a stock, hoping the growth story continues, but all the data suggests the best part of that story has already happened. Think about what you're really buying. When you buy Amazon stock at current valuation, you're paying for revenue growth that may or may not continue. You're betting that $120 billion in AI spending will somehow generate adequate returns, even though there's no clear evidence of how that will happen. You're assuming AWS can maintain margins while Microsoft and Google compete aggressively. And you're hoping e-commerce will somehow improve profitability while Walmart, Shopify, Temu, and dozens of other competitors attack from all angles. That's not an investment. That's a collection of expensive hopes. Compare that to what I look for in a solid investment. I want a business that generates consistent free cash. I want margins that are stable or improving, not deteriorating. I want a competitive advantage that's defensible without requiring billions in annual investment just to maintain. Amazon fails all these criteria. They're burning cash on increasingly larger investments. Margins are worsening quarter after quarter, and their competitive advantage requires such massive capital spending that it questions whether it's really an advantage or just an expensive race that never ends. Charlie used to tell me that the trick in investing isn't knowing when to buy, it's knowing when to sell. And you sell when fundamentals change, not when the stock price drops. Amazon's fundamentals have changed. They've gone from a company building lasting competitive advantages to a company fighting to maintain position through unsustainable spending. The market hasn't fully realized this yet because it's hypnotized by revenue growth numbers. But eventually, just as happened with GE, with Sears, with so many other companies that seemed invincible, the market will wake up to the reality that size isn't the same as sustainable profitability. And when that happens, investors who waited will lose much more than those who sold when the warning signs were obvious. Amazon has reached its peak. The numbers don't lie. And if you're still holding those shares hoping the magic returns, you're not investing. You're betting against mathematics. And betting against mathematics never ends well.